Hi, I'm Stacey Hyde and I'm back for another episode of Better Financial Health in 15 minutes or less. And today I would like to talk about something that has been pretty timely. And it's about market volatility, particularly the downward kind, because that's where we tend to get the most phone calls, where people get concerned. And what I would like to remind most people is that the action that happens in the market in a particular day or a month or even a year really doesn't impact or shouldn't impact their long-term financial security. Because one of the things that when we're running projections for people, we take into account that markets go down, that we're going to have bad returns. And by bad, I mean, depending on your allocation, we may expect your account to be down 10-15% or more in a particular year. That's not necessarily cause for concern. Is it fun? Absolutely not. Is it awful? Yes, we don't like it. We like seeing our accounts go up. But what we have to remember is that's the way markets work. And at the end of the day, the markets work and the market is your friend. That's the best way to build wealth longer term. And oftentimes people call me and say, well, I want to sell out right now because things are looking bad. They're worried about the election. They're worried about whatever they're worried about, what's going on in the world, which I understand. But then the question I ask is, when are you going to know when to get back in? And my favorite example of this, because there's really two. The most recent is the COVID crash that happened in 2020. It was terrible. We didn't know what was going on. Markets had come down a lot. The whole world was shut down. But if you had sold out then and waited to get back in, you also missed this huge uptick that happened. Because as soon as the market saw that there were vaccines coming, the market recovered. It took a long time to get those vaccines out, distributed, and for us to actually get out of sort of the COVID era. But the markets reacted very, very quickly. Another example is the great financial crisis. Things started kind of getting ugly, little bit sort of cracks in the iceberg in 2007. 2008 was awful. 2009 was really kind of the worst of it as far as what was going on in the world. But the market bottomed in March of 2009 and then went straight up from there. And so if you had pulled out because everything was bad, banks were failing, you would have missed the beginning of one of the great bull markets of all time. And that's why I tell people, you have to stay invested. I will never forget, I had a client who one of my favorites. We had gone to lunch at Christmas in 2008, and he and his wife went, and he fussed at me pretty bad, so much so that his wife called me after and said, he loves you, right? I was like, I know he needed to vent. But I told him, I said, I'm not going to let you sell out. You have to stay put. And then we had to fund his pension plan in March. And when he gave me the checks to fund those, and they were not insignificant checks, he told me, he said, girl, do you realize what a statement of faith this is that I'm handing you this? And I said, I understand the assignment. So we put those in, and as luck would have it, we put it in the day the market bottomed. So even though markets were off 36%, whatever, over that year, because he put such a significant amount in at the bottom, he actually had recovered his losses and was at break even by October, November of that year. And so that's why I tell people, you just have to be patient and let markets work, because while it's not impossible to get to pull out and say, okay, the markets are down, although the people that were calling yesterday, the markets were already down, and as I'm recording this, they're back up yesterday was August 5th, today's August 6th of 2024. The markets are already doing better, and I just could not bring myself to let people sell out when the markets had already, NASDAQ had entered correction territory yesterday. That's not the time that you want to sell. There's I'll probably get Naya to use it as the graphic for this podcast. And it says, it's done by Carl Richards, who is a former artist for the New York Times. It says, you've always heard you're supposed to buy low, sell high. Well, what he says is buy high, sell low, repeat until broke. And while it can be comforting to say, I'm going to get out of the market now, you're going to miss out on so many opportunities and so much wealth. I mean, let's be real. And it's also not just about money, it's about funding your goals, funding your moment of being work optional, funding kids' education, funding your vacations, funding your first home. It's all of those things where we need capital to do it, and we need our capital to work for us. And so patience, and when the stress becomes overwhelming, study after study shows that a hug from a friend or family member, getting out in nature, getting away from the screens, getting away from the talking heads that are yelling at you on CNBC or Fox News or whatever, get away from the screens, get out into nature, get with people you care about, and I promise you, life will feel much better and you'll have a lot more ability to make decisions. That being said, one side note, any money you're going to need in the next 6 to 18 months should be in cash or a money market fund or a bank account. It shouldn't be in the market. Things that you're going to need soon, you can't take the risk of the market because you have a fixed time that you need it, and that period of time is not long enough for the stock market to work for you. You might get lucky, you might not. I think that your time horizon should match your need for the funds. Thanks so much for tuning in. This has been another episode of Better Financial Health in 15 minutes or less.